Piece here from Bloomberg by Alison Strager. A 50-year mortgage, it's not a terrible idea. I'm going to tell you why I think it is a terrible idea. For many years, most of us are accustomed to the 30-year fixed mortgage out there. And when you're talking about the 30-year fixed mortgage, typically the way that rate is determined is by using the U.S. 10-year Treasury as a benchmark to dictate what rate that a bank is going to assess you when you borrow the money to buy a house and put a mortgage together. There are very few securities. You could make some arguments perhaps on a 20-year Treasury or a little bit shorter than that could be used to price a 50-year mortgage. And oh, by the way, if you're the bank, imagine lending out money for a 50-year period. You're taking on a whole lot of risk as a lender to commit to 30 years, but to commit to 50, almost twice that period of time, is a significant risk. You run into all sorts of complications as the lender. If I'm the borrower, Paul Lane takes a 50-year fixed mortgage, I could lose my job, get divorced.
A bank could do this now, right? They just wouldn't be federally. They're going to lavish it with federal subsidies,
right,
is the issue here, I think. Like, as a private lender, you do whatever you want. Correct me if I'm wrong.
You could, yes.
They just don't, because they all want to conform, and they want to securitize their sorry, this is just off the top of my head, not my area, but as far as I know, everybody conforms to the 30-year structure because it's easier to move the loan off your books if you want to sell it, for example.
Yeah, the mortgage-backed securities market far more liquid for that than a 50-year one that just doesn't exist.
The government would have to actively aid and abet this practice,
right? Provide some liquidity for it, and then you have the other issues here that if you lend at really low rates of interest and interest rates run up, as the lender, you're missing out on that opportunity cost there by being locked in for a significant period of time.
Yeah, so banks may not want to hold on to these suckers.
To me, that's the biggest thing is for a consumer, what are some of the downsides to it? I mean, yes, your monthly payment gets lower, just like the trick that they'll do to you if you go buy a car. They'll stretch you out on monthly payment by just making the loan longer. Same thing would be applying here. Oh, don't worry, Mark, we can get you in this car for $250, $500 a month. Oh yeah, you're just gonna have to have a 10-year auto loan that you're paying interest on. Same sort of concept here. The 50-year mortgage payment is gonna be pretty low relative to the 30-year one. You're not building a lot of equity by doing that, and you're not making a significant amount of progress paying down the principal.
Yeah, if you stay up at night worrying about the potential for negative equity now, you'll be worrying about that potential for potentially your whole working life under a 50. I'm not saying it's a bad thing. I'm willing to let the market sort this out. But that's not really actually what's happening here. The government will be actively encouraging or will be facilitating the development of this market through, again, subsidies and regulations. And Schrager makes good. I mean, I'm in her camp as a sort of libertarian-leaning occasional economist. That's her full-time job, and she's a PhD. So she knows her stuff. She outlines the pros and cons pretty clearly. There's no way consumers will understand what they're getting into here, though. To your point, car dealers find it very easy to trick us, as you put it, because most of us can't do, myself included. I have to spreadsheet it out or something.
I have to have the calculator next
Yeah,
to me.
you do. We have our little financial calculator, so we know what we're paying in interest over the life of a loan, but it is not straightforward. It is complex, and it's fully disclosed when you take one of these suckers out, I guess. But
buried a little bit. And again, important to note here, this is all theoretical chatter. There's not imminently going to be a 50-year mortgage issued, but it's just something that has been...
What does it do for the housing? We haven't talked about implications for the larger market, though. Presumably it increases demand. That's going to push prices up.
Yes.
All else equal, right?
And
if it makes houses more affordable?
The altruistic idea behind this is trying to get more people in houses because of the affordability issue. But to me, this is not attacking the right part of the problem. It's the supply side that you should be attacking. I don't think that really Washington, D.C. has any real fixes to fix the supply side. So that's why perhaps you turn to the financial instruments as a way to combat that. But I don't know if this really solves it all.
No, if you lament that home prices are too high, this is not a prescription for that. This will push prices, I assume, all else equal, by making houses more affordable, by enabling, as you pointed out, people to stretch their payments out, will make it easier to buy a house, and thereby, again, all else equal, push up prices.
Yep.